We empower those who act, those who see the correlation between upswings and downswings, those who manage risk.
And so the question is, how much more room, how much more upside objectively?
Robust. There is no reason to get out of this restrictive territory. Now, is there pressure from overseas central banks? We saw the Swiss bank cut for the second consecutive meeting, another quarter basis point, via the Bank of England. Over the next couple of months, based on data, that if these other major central banks continue to cut or start to cut, that's going to put some more added pressure on the Fed here in the U.S. But at the same time, they're going to be data dependent, Ben. If we continue to see those trends on inflation start to pull back, I think that'll be key moving forward.
Yeah, we're going to talk in just a minute about one of those contributing factors to those trends associated with inflation's pulling back, and that's crude oil, which has been inching up, right? So that's creating a little bit of a headwind for that narrative, that headway that we've made. Bank of England, 2 times point, leaving rates unchanged this week. Swiss National Bank raising rates, or lowering rates, and you had the ECB, which cut rates last week also. So that does kind of tip the hand of the Fed a little bit, or they want to kind of get a peek at it, it seems like.
And look at the impact, real quick, Ben, sorry to interrupt you, but the impact of the currencies. If you've seen the dollar this week, it's grinding higher. We're at levels 7-week highs for the dollar. What kind of impact is that having on equities, or will it have on equities if that trend continues? And the Swiss bank, I think part of the reason they did another cut was to kind of put some pressure on the currency markets at this point. And that's why you're seeing the reaction to the dollar to the upside.
Real quick, 2 more things. First off, equities this week more focused on yields coming off than the dollar. 4.63 since the beginning of June, all the way down to 4.18.
Yeah, if you look at the 10-year, down 26 basis points so far this month in June. So that's lending support to that narrative that the Fed's going to cut before they're actually saying they're going to cut. So you have to take that into consideration, because the market wants what it wants. That's why we're at all-time highs. The optimism's there. We're in a kind of a sweet spot for that soft landing. So yeah, watch the yield market over the next couple weeks, because we don't have a lot of earnings. We don't have a lot of economic data that's going to sway markets. Watch interest rates, watch that dollar. If that thing gets back above 106, Ben, that could cause some pain for equities also.
Lastly, triple witching today, quad witching, and now triple witching, right? Because you don't have the stock futures products, which are expiring, right?
Yeah, a lot of people still call it quad witching. We haven't had stock futures expiration since 2020.
Okay.
They've kind of pushed those away. So it's basically equity.
Triple witching.
Yeah, it's equity options. It's index options, it's futures options, expiration today. That could throw some added volatility in it. And I mentioned the rebalance of some of these major indices and ETFs that are going to take place today. And we've had a gamma squeeze a little bit here for the option markets. Will that lend some additional volatility? We saw the VIX pop over 6% yesterday, back above that 13 level. So a few things to watch here. But you know what? The triple witching, I think, the 0 days to expiration options trading that's been taking place has taken a little bit of shine or luster off of what we used to consider a big event on a quarterly basis with triple witching.
Okay. Could see some price swings today, though. And I would say not a lot of rhyme or reason associated with them. You kind of just have to chalk it up to the again, options activity, but and the expiration activity. But 2 times point earlier, it is kind of a quiet week as we look ahead to next week. Looks like consumer confidence, GDP, durable goods orders, some housing data, consumer sentiment. But it looks like Nike, Walgreens, and a couple other names to keep an eye on: FedEx, Micron.
Yeah, FedEx. Micron. CCL in the space of that's done really
General
well.
Mills.
Yeah, General Mills.
Okay.
Nike also. So we get some consumer data with the confidence and sentiment data that you mentioned earlier. That'll be important. That second read of GDP will be focused on durable goods orders. But I think watch the consumer. If we see some continued softening and weakening data points as far as confidence and sentiment goes, does that give the Fed that path to cut rates a little bit quicker than maybe the Fed stated earlier, but then also the strength of the economy? Because the consumer's been holding up the economy pretty well as we're just off all-time highs. So continue to watch those data points also.
Nike always signaling that kind of tail end of the last bit of earnings, and then ultimately it's only a week before we talk about that next round of financials kind of reporting again. So that will give us something to talk about in the coming weeks as well. Tom, appreciate you joining us here this morning to take a look at the headlines, top stories, what's on the minds of traders. Check Tom out throughout the day here on the Schwab Network. And we're lower across the board as we head into the cash open. Stocks have, again, taken a bit of a pause from that breakneck pace rally we had seen throughout the week here. We're going to talk commodities when we come back, though. Stick around. Ed Egalinsky is joining us this morning. Here from Direxion, take a look at crude oil and more futures after this.
Every morning, our analysis is your blueprint for the day. Bonds, stocks, across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Crude oil prices on the rise higher this week, and well, this month for that matter, putting a bit of a bump in that road that we've seen, that path along the way back to that 2% target that the Fed's been, achieving, or attempting to achieve, I should say. Let's take a look at crude prices recently in the rally, because while we have seen a nice move up, still relatively contained on the bigger picture, but could be the start of something here, and I'll show you exactly what I'm talking about. First and foremost, the move up this week. We've seen from 77.58, bottom left corner of your screen, all the way up to 81.52. We're holding this upper level, so we're talking about a $4 rally, essentially. A significant move when you're talking about it over a short period of time, right? And this comes after crude prices have actually been selling off, so kind of providing a little bit of optimism in terms of those inflationary targets. Here you can see this is sort of a headwind, again, for those efforts. But I wanted to identify just a couple areas where the market has paused and established value along the way up. Again, as we take a look here, the market has been and continues to be it's in a very well-defined trend to the upside here. Okay, so let's move away from crude oil here on this 15-minute time frame, and I want to take a look as we add a little bit of time on, and I want to show you how that rally that we just looked at this week, again, from that $72 level, 77 all the way up to 81. It's not just this week, right? It's really been this month, as I mentioned, all the way up from the beginning of June. We started out around 72. A bullish pattern here across the board here, right? Bottom left to top right. And as I take a look here at this pattern playing out here. I wanted to show you again along the way up and more recently some of the areas of consolidation that formed higher and higher levels. Take a look at this 15-minute candle chart here. Again, a very bullish pattern here. And take a look here, because that rally that we've seen off the lows again from the beginning of June, well, it invalidated a bit of a downtrend that we had been seeing. This strong move higher again, reversing a bit of a pattern, a nice V bottom off that 72 level, in fact, that played out here. Taking one more step back from the 15-minute candles here now into a bigger picture chart here, I just wanted to show you also another very bullish pattern playing out. So still contained, as I mentioned here, crude oil, again, kind of limited in terms of real conviction on the bigger picture, range bound, and many could argue, or we have in many ways argued, contributing to this rally we've seen in stocks on the longer term. But hey, if this builds momentum, if we get back up and through a couple key areas here, ultimately 95 being a big level, then again, a major headwind for the rally we've seen in stocks and ultimately for some of the progress the Fed's made in terms of their efforts to drive inflation back down. Crude oil finding support at some key levels and on the move higher, a product to watch into next week. Now, to focus on the fundamentals behind the technicals and the rally we just looked at this week and this month, Ed Eglincy joining us, Managing Director, Head of Alternative Investments at Direxion. Ed, good to have you here this Friday. Thank you. Is what we're seeing a delayed reaction to the recent OPEC meeting, possibly helping crude regain its footing here?
Next key level, Ben, is around the 83, then 85 level to push higher, but the trend is certainly bullish right now. You know, after the OPEC meeting, crude consolidated a little bit, drifted down, but then I think when people reevaluated what OPEC said, that those voluntary supplies coming back into the market may be a little longer than anticipated, so that alleviated some fears. But the biggest thing, Ben, that's been really keeping a risk premium or a floor on crude has been the geopolitical risk, and there's been some renewed unfortunate risk, both in the Middle East as well as Russia, with the drone attacks just last night by the Ukraine. So when you look at right now, inventories as well, last week they unexpectedly dropped, and supply-demand balance is expected to tighten in the third quarter for crude. So yeah, you have some bullish signs here right now.
You sure do, and a lot of people calling for this commodity super cycle to, at some point, kind of regain some of that momentum to the upside. We've seen copper prices, metals come off a little bit, but geopolitical tensions, to your point, inventories, contributing to the rally, right? Does this imply, do we expect to see, do you look for higher commodity prices? Do you think the super cycle's in full force here?
Well, even despite the CPI and PPI numbers most recently, which shows that inflation is cooling a little bit, you know, inflation is still persistent. As a result of that, you know, commodity prices should remain elevated. And if you do get a Fed rate cut, Ben, that's probably going to be good in terms of the dollar weakening, which should benefit most commodities. The other thing is, everybody's talking about the strong labor market. I think it's a little deceptive in terms of the jobs added. A lot of those jobs being added are lower income jobs. So you could debate on whether or not those job numbers are as robust as people are saying.
Ed, talk to us a little bit about natural gas prices recently coming off, what was it, around 315, 320 area, back down to 270. But as you take a look, kind of just retracing a strong rally similar to what we were talking about throughout the month of June, where natural gas prices basically rallied. We're talking from, what was it, around 280, it looks like, end of May. I'm sorry, around 240, 250 around end of May, up to that level, as mentioned, around 315. So, and even as I look here, I think this is the chart I wanted to pull. Yeah, natural gas, look, I mean, bigger picture, you can see we've seen a significant rally off below $2.
Yeah, I mean, you were up 30% alone in May, Ben. But right now, if you look at the technicals, natural gas is at a critical level here. It couldn't hold that 280 area, 280 to 285 area. I think it broke a little below last night. So maybe you'll see about 250 to 260 before the resumption of a potential rally. But all you have to do is look at whether it's Chicago or New York. I know you're based in Chicago. The hot temperatures across the U.S. right now. You know, that's where natural gas is going to get some traction, and you're continuing to see hotter weather throughout the U.S. Of course, that'll mean an increase in electricity needs for utility providers. And AI and big data, Ben, you talked about NVIDIA. Natural gas is going to be a continued big player in that, and that's not going to go away. What's interesting also is right now Europe is stockpiling natural gas as a result of not being able to rely on Russia for supply. And then I think it was just yesterday, China going to curb and regulate natural gas usage to adopt that. So there are a number of tailwinds right now for natural gas, but that 250 level is going to be key for natural gas to hold.
We'll watch 250, Ed. We were talking before the break about gas prices, or during the break, kind of joking around about this one station here in Chicago, which is traditionally just way over the top. I mean, in terms of prices, right? It's probably, we were joking about $6 right now. No joke. I mean, definitely over $5. And
is that what you fuel your Maserati?
I'm looking at this AAA. According to them, the national average around 345. We're coming off, it seems like, a month ago, 360, a year ago, 358. I mean, gas prices relatively tame. Talk to us about commodity sectors in general, and where do you see some of the opportunities as we head in the second half of the year?
Well, it's interesting. If you're talking about gasoline, just for 1 minute, Ben, jet fuel's definitely the demand's up. Gasoline demand is about a little less than last year at this time. As you mentioned, the average price of gas is down a little bit from last year. But keep in mind that it is an election year. The political implications on the direction of gas prices, and they are releasing strategic petroleum reserves this summer to help keep prices down. So it'll be interesting to see what happens with gasoline. And also the wild card always is the weather and potential hurricanes are coming into that season. In regards to your question, best opportunities for the balance of 2024, certainly the metals still come to mind. Because if you get a risk-off environment and the VIX starts popping, you got to believe that flight to safety trade with gold and even silver to a certain extent, might continue that rally there. And also, if you get rate cuts, it's going to weaken the dollar. That should be beneficial to the broader commodity markets, but especially the metals. They're most sensitive to dollar strength. So a weaker dollar should help the metals in general. But, Ben, that super cycle, what's going to trigger that still? The lack of CapEx spending, the continued geopolitical risk, ongoing supply concerns, and the word stagflation. I don't know if that's going to come back into play, but the lack of growth, still higher inflation, I think that can come into play as well.
My gosh, a while since we heard about lack of CapEx spending, but definitely a factor to consider. All this having been said, Ed, talk to us about how the Direxion COM ETF is currently positioned to take advantage of some of the opportunities you just mentioned.
Well, the COM ETF a little unique. We're long 6 out of the 12 commodities right now. Crude oil and gasoline among them, the 3 metals, copper, gold, and silver that we cover, and then just most recently wheat. We're long a commodity if it's showing a favorable price trend, and cash with the commodity if it's showing a downward price trend. So when you look at it right now, we have about 50% exposure to those 12 commodities, being long 6. And, right now, if you're in cash with certain commodities, you're getting paid to wait with where yields are right now.
Recently running into some resistance up around 30.60, it looks like, but still holding up near the upper third of the range that we've been in over the last year or so. Ed, appreciate you sharing part of your Friday with us here on the network. Ed Egalinsky, Managing Director and Head of Alternative Investments at Direxion. Coming up, a quick break. When we come back, you got Scott Bauer headed your way, CEO of Prosper Trading Academy. We're going to talk Bitcoin and some of the news this week that's been impacting price. Jenny Horn's also with us this morning to take a look at a couple stocks that are making headlines, a couple companies you should be keeping an eye on into the open. We've got Amazon, we've got American Airlines on our radar. We've got lots more futures headed your way. Stick around. We'll be back after this.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
bonds, stocks across all asset classes on Morning Trade Live on the Schwab Network, weekdays at 9 a.m. Eastern.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the second half of the Futures Show. Headed into this cash open Friday, we're seeing stocks pull back a bit off that all-time high that we saw yesterday, and lots to focus on. We've been breaking down some of the headlines this morning and what's on the minds of traders as we head into the cash open. A product that we haven't covered a lot is definitely something to keep an eye on here into the second half of June and second half of the year. That's Bitcoin futures. After yesterday's call from Berenstein, I want to bring in Scott Bauer, CEO of Prosper Trading Academy, to help us break down that call yesterday and what it means for the futures contract. Scott, I also want to talk currencies and treasuries, but first, a product, as I mentioned, that's kind of been off and flying below our radar. Bitcoin no longer after that call yesterday. Berenstein calling for 200K between now and January.
Optimistic as you can get, even more so than Kathy Wood, I think. You look at Bitcoin, and we all look at it on a day-to-day, on a micro basis, and it certainly has been trading in a range. It is down at the lower end of the range, but I think the fact that the last few attempts that it couldn't get through 70,000 or so, that's problematic for the Bitcoin bulls. Now, it is really trading, Ben, over the last 6 months or so, or ever since the big run up with the ETFs and the halving, it has been trading pretty much lockstep with the Fed and interest rate policy. So if we start to see the Fed maybe change a bit here, if the eco data continues to come in soft and those chances of a September rate cut do increase, right now they're sitting at, I think, about 65% or so, you could see Bitcoin rally from there. But boy, that's an aggressive call for the next 6 months to basically triple.
To say the least. Taking a look at the chart here real quick, I just want to point to, as Scott mentioned, with yields coming off, we've seen Bitcoin come off, right, from 72.6 here and all the way down to 63.5. I want to just show you where we are in the bigger picture, because Scott also mentioned the fact that we've been in a bit of a range. Scott, I feel like one could argue when we were range bound in the beginning of the year, right, into December of last year, beginning of this year, we were kind of contained around this 43, 45 level. I would argue that the bulls are very happy with what we're seeing up here right now, the longer term bulls, right? No, we're not at that 200,000 level by any means yet, but this is value forming at this upper level. No rejection of the rally that we saw to just shy of 75,000. And for the record, that call for 200,000, as far as I remember, is up from 150,000 from the prior call. So that's a pretty optimistic one. But again, this chart gives you a lot of reason to be optimistic. Yeah, you don't like to see that recent selling, but within this range here, still a bullish pattern.
There's no question about it. So if you expand, instead of looking at a day-to-day, like what you just had up on the screen there, if you expand that, we are in a range. We're at the lower end of that range, but we are in a range. And we know with Bitcoin specifically, when we see that coil, when it kind of just sits in a range for a while here, that is usually a precursor to seeing a big breakout one way or the other here. Yeah. Obviously, Berenstein is looking for that to be the upside here.
Yeah, I kind of think of it as sort of like a pop bottle that's being shaken up here. Eventually, it does right, explode. Talk to us about what's going on here, because yields have been coming off, right? We've seen data which has been supportive of the fact that the Fed's making progress on inflation, but not necessarily cratering the economy or creating a situation here we have to be concerned at this point.
Yeah, I mean, the Fed likes the data that's coming out, and as you know, we always discuss. I think you have to be careful what you wish for. We don't want to see the data, coming in too soft continuously here. But yeah, the Fed likes this here. September probabilities again are about 60 to 65% of a rate cut. But when you compare the Fed to other global central banks here, I think that there is still a very, I don't want to say hawkish stance, but the Fed is not as aggressive, obviously, to be cutting rates or easing policy as other central banks around the world.
I think that's interesting you bring that up, Scott, because I feel like that would create a situation where the dollar, in theory, would be buoyed, right? We would see it maybe 106, 106.5 even, inching its way back up to 107 on that premise. But then you also have yields which have been falling, which in maybe some ways creates balance, which we know the market likes balance, right? So that kind of feeds into what we have seen here in terms of stocks at all-time highs.
No question about it. And I think that is why the dollar is hanging in the 105 plus range and not down at 104, maybe 103
with yields lower, you mean?
It's exactly right. So it is balanced there. I know the chart that you have up on the screen there, we can see that there in that 106 to 107 level you were talking about. You would think that maybe the dollar would be up there, but the eco data is kind of fighting that. So it's a real interesting dynamic right now. I do think the Fed is, in comparison to other central banks, is definitely on the hawkish end of things here. That doesn't mean that they are hawkish overall. I'm just using that as a comparison, especially when you look at Japan, which didn't do anything. Many had expected to see something there. They really didn't do anything. You look at the ECB, you look at the Bank of England, and the Fed is standing pat.
Yeah. Hey, if we could pull that chart back up again real quick, because kind of getting back to our comment and discussion or thought about Bitcoin earlier, in a bit of a range, right? So here we've got the dollar, which has been somewhat range-bound contained as well. I feel like kind of falls under that category, shaken up, pop bottle. Eventually we're going to blow the top or the bottom off of this thing. Scott, we tried to get you on record, or had you on record, saying that the ECB was going to be the first one to cut, right? And just because that was a scheduling issue, though, right? That was the Bank of Canada. They got to go a day before. So in theory, you were right in many ways, we'll call it. But okay, so now let's get you on record here. I mean, which way is the dollar going to break out? Are we going to see above 107, or are we going to take out those lows that we had on that chart earlier?
I would say that the dollar is going to be heading lower over the next few months. Now, in the interim, over the next days, week or so, we could see the dollar tick higher just based on eco data coming out elsewhere. But I think that it's going to be a tough fight for the dollar here if, we are expected to lower rates in September. If our eco data still comes in soft, regardless of what happens elsewhere here, I do think there's overall pressure on the dollar.
A different scenario, though, per our discussion, if we see the Fed unable to cut rates while Europe and other central banks are, right? But not necessarily creating a situation where we'd see a blowout top there either. Do you think that would still just kind of feed into this containment?
Absolutely. I can't see a scenario really where there's going to be a blowout top here
for the dollar,
unless over the next several weeks, maybe we get a June jobs report that is
really
a blowout on the upside. Right, exactly. I just don't see that scenario happening.
Yeah, inflation starting to kind of rear its ugly head again. Now, hey, we were just talking in the last block about crude inching its way back above 81 as we head into the end of the week. And a reminder for everybody, still ongoing geopolitical tensions, right, in Middle East, in Ukraine. So stories to be watched as well. Let's keep an eye on this as it develops, Scott. I appreciate you joining us and sharing part of your Friday morning with us.
Have a great weekend, Ben.
You too. Scott Bauer joining us here and sharing part of his Friday with us, CEO of Prosper Trading Academy. Now to check on a couple developing stories, I'm going to bring in Jenny Horn, markets correspondent here on the Schwab Network, for a look at Jenny. Good morning. Amazon's on your radar. They're mulling over some massive Alexa revamps, it sounds like.
And my goodness, Ben, it's about time because Alexa, I mean, I feel like this is technology that's like 10 years old at this point. You'd have to think with like the improvements and the advancements in AI, Alexa would finally get the weather right because I have a close personal relationship with my Alexa and she does me wrong all the time. But nonetheless, we are seeing that they are planning, like you said, this pretty major revamp of course, the segment of their business that has been losing money, which has been the Alexa segment, to include a more conversational generative AI with 2 tiers of service that is expected to have this monthly fee of around $5 to access the superior version, according to some reports we got. Now, known as Bayan, the reference to a sprawling fiscus tree, the project would represent the first major overhaul of Alexa since it was introduced back in 2014, along with the Echo line of speakers. Amazon has dubbed this new voice assistant as the remarkable Alexa, according to these sources. But we did hear that 8 current and former employees who did work on Alexa, were speaking on the overall condition of anonymity to remain more anonymous, were not authorized to discuss. But that is where the reports are coming from. I saw it reported out of Reuters, I believe, as well. But Amazon has been pushing its workers towards this pretty major deadline of August to prepare for this newest version of Alexa. So we did see CEO Andy Jassy has taken on a pretty personal stake in revigorating the overall brand. Again, I just have to think right now in terms of like the AI arms race, we're calling it, you'd have to think, of course they should be improving Alexa. I mean, this is like the original AI feature that to me feels so dated at this point.
Yeah, I tend to not fully utilize some of the Alexa capabilities, that's for sure. I'm not really scared by it by any means. I just kind of, again, to your point, I feel like it's sort of outdated.
It's a mistrust. You don't believe that she'll work.
Yeah, it doesn't really keep up pace, I guess is the best way of putting it, right, in terms of some of the ongoings within your household at this point. But let's see if they can make some progress on that. Let's talk a little bit about another stock that's also making headlines. Looks like American Airlines following this flight attendants dispute, and it looks like a union strike.
I know, if you can recall, last summer we had the summer of strikes because we had all those various strikes. It feels like it's somewhat reminiscent of that, but American Airlines has failed to now reach an agreement with the Association of Professional Flight Attendants, or AFPA, in the latest round of negotiations that were held this week. Now, we did see that Reuters did report the AFPA represents about 28,000 American Airlines flight attendants, and according to the union, this recent failure to reach a deal brings them closer to a strike. We also did hear a statement from the AFPA president saying the company did not offer adequate agreement terms and that the flight attendants will continue to process to secure economic improvements. Meanwhile, American has said in an emailed statement it plans to continue with the negotiations with the union. So, I mean, it's the latest round of strikes with the airlines, and I have to say, I feel like after reporting on this for quite some time, it's like, you right now have such a massive understaffing issue as far as like pilots, flight attendants, and staff goes. Pay these people, get this headache out of the way, because it just seems like it always ends up falling in favor, at least it should, of the union. And it's like we do this song and dance and it takes a while. We see it impact, obviously, the stock price. And it's like, I wish we could just reach a conclusion already, because as anyone that's traveled recently knows, we need these planes and overall airports to be well staffed. And it seems like that's been a major issue with some of the overall delays and cancellations of flights. So American, I also will say, has definitely needed an upside catalyst. We're supposed to be in these peak summer months of travel, and they just keep disappointing as far as like their guidance and continued reduced expectations now for the rest of this year.
Okay, Jenny, I've got a funny story which kind of brings these two together. Bear with me because it might take a minute to get out, but I've got a friend coming into town this weekend for a wedding who told me about 2 weeks ago they're going to send a package to my house, right, and kind of warned me or gave me a heads up to look out for this package. So something arrives yesterday in an Amazon box from Alexa to Ben Lichtenstein. I open it up and I'm pulling it out and it's a dress. And I'm thinking, to your point, Alexa's got me way wrong, right? It actually has a note in there signed from Alexa, a gift for you. And ultimately, or thank you for your business, the note says. And I'm thinking, boy, Alexa's got me way off, but it turned out I was the one that was wrong, and put 2 and 2 together and realized that this was the package that my friend had sent to me for her wedding while she's in town. So ultimately, yeah, I guess we'll keep an eye on these two stocks as we work our way through the day.
Hey, Alexa told
No
me
laugh there, I guess.
it was good, like 60 degrees out right now, and there's no way it is. So I still have my own personal gripe to pick with her this morning.
Okay, but that's been some crazy weather in Chicago, right? Even on the radio, they're like sunny, and I look out and it's foggy, right?
Right.
So, I mean, it's been a little bit of unusual circumstance here. But Jenny Horn joining us, taking a look at a couple names. Me trying to tie them together, but maybe there wasn't a direct tie there. Maybe in my own world. Okay, coming up, we got Ben Watson talking triple witching and what it is, how it impacts prices, and what it means for us as traders today. The chart master Rick Ducat's going to take a look at that breakneck rally we've been tracking in the S&Ps and the pullback off the all-time highs. More futures after this. We'll be back.
Every morning, our analysis is your blueprint for the day. Bonds, stocks, across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on next-gen investing. 1 p.m. Eastern, only on the Schwab Network.
Welcome back to the Future Show here on the Schwab Network. Got some good news for the bulls. We actually just saw positive territory in the NASDAQ and the Russell. So inching our way off those lows as we head into the open this morning and trying to recover some in terms of some of the selling we've seen off those all-time highs. I want to bring in Ben Watson. He's joining us this morning, Senior Manager of Education at Charles Schwab, to help us dive a little bit deeper into this triple witching. Ben, what is it?
Well, Ben, let me set the stage a little bit here, because quadruple witching or triple witching, if you include, or quadruple if you include single stock futures, is what happens 4 times a year when traders gather at the altar of expiration to worship these closeouts of not only stock index futures, stock index options, stock options, but also those single stock futures. Ben, sounds a lot more ominous than it really is, but we get it every third Friday of March, June, September, and December of every year, but it can add some additional volatility to the market, Ben.
Yeah. Okay, wait, the altar of expiration, we used to call that Ceres. That was the bar in the lobby of the Board of Trade, and that's where we would come together and meet up on expiration Fridays. Some before, most after, but definitely some before the close, I can remember. But talk to me again. Now, impact on prices, right? We mentioned earlier in the show it could have or contribute to some volatility intraday, but I always say it's got very little rhyme or reason associated with it.
You're absolutely right. I mean, it can create some intraday volatility. In fact, we look at the fact that the VIX itself is up about 8% today. The VIX one-day index up 29% in the last 2 days. That's more reflective of kind of that spot volatility in this rebalancing and in these closings of these positions. VIX futures up about 5% in the last couple of days. So it creates that additional volatility. Does it have a direct impact on price? That remains to be seen. I mean, it certainly increases the gamma going into this expiration Friday because of that potential for change and a lot of those positions being rebalanced. Look, we're looking at 5.5 trillion roughly in options contracts set to expire today. Okay, and that volatility changes price.
So short term, we could see some impact on price. Ultimately, talk to me about long term, right? I mean, lasting effect, not really.
No, not really. And I think it happens. It's part of the process. It isn't something to be afraid of. We create these kind of ominous names for things, but at the same time, you think about directionally. Look, we've got a call to put ratio of expiring options at 11-1 on the call side. That maybe suggests that there is still a little bit of bullishness there. Again, that depends, and especially given the fact, Ben, that we are in a summer market. It's a holiday shortened week. There's not a lot of trading volume going into this quad or triple witching. That can push prices as well.
I think that's a good point here, Ben. And just to kind of sum it up, it sounds like, again, headed into this sometimes volatile event, right? And especially in a thinly traded market, summer markets, oftentimes that sort of exaggerates things a little bit. But this is really just one more piece of the puzzle, right? It's going to provide a little bit of insight, but not necessarily a corner piece by any means, it sounds like.
Not at all. I mean, we can create kind of the mythology around it, but it is simply a part of the process. That rebalancing is going to maybe be the longest term impact as we start to see some of these indexes do their quarterly rebalancing. Happens to be coincidental to this quad or triple witching day, Ben.
Yeah, let's definitely focus on this, but also keep it in perspective, I think, is important. Ben Watson joining us here to help us break it down. And for those who aren't aware of triple witching, quad witching, what it is and the impact it has on us as traders and price. Ben, thanks to you, and we look forward to seeing you here back next week. Ben Watson, again, helping us break it down. And let's further that discussion with Rick Ducat. He's the chart master. He's got his eye on the technicals. The rally we were talking about to start the show. Rick, a breakneck pace this week to new all-time highs. We pulled back a little bit here, but not necessarily anything to indicate that the trend up we've seen has been invalidated.
Yeah, hopefully triple witching won't put a hex on these markets here because we've been trending upward nicely here. We had our trend line starting with these lows right here from about a week ago, or 2 weeks ago rather, and we have been trending up since that point. We had our contract change. That's why we have this large gap here. It wasn't from price action. It was we switched to a new contract here. But nonetheless, it gives us a low point to keep an eye on here near 54.90. So we also have a high point, 55.88. So we've got some kind of natural boundaries here. We do have right now a kind of a confluence here between our trend line and those lows. So be on the lookout if we start to move down toward that area here. But for right now, we're hanging on.
Yeah, pretty well-defined trajectory here. We're talking 2 steps forward, 1 step back, trend up, bottom left, top right. I mean, we could describe it 5 or 6 different ways. I've been saying all week, blindfold me, spin me around 10 times, Rick, put a dart in my hand, and I'm going to throw it and probably hit something that's fundamentally bullish this market, right? And you can see, again, with that gap, the rollover activity, a bit of a pullback, but still, again, holding these upper levels, right? Still holding about 5,500 convincingly, to your point, 54.90 to watch the downside, 55.88, 55.90 to the upside. Take a step back here from this hourly candle chart with us and show us exactly where we are in the bigger picture, because we've been talking about how this trend up we've seen, hey, it's not just off the April lows, it's not just off the October last year lows, and we could go all the way back to October of 2022. I mean, this has been a textbook example of what we look for in terms of trend up.
Yeah, some interesting developments taking place. So you can see we had a rise upward, a decline, another rise, another decline, and then a push to the upside that took us above those previous high points here near 53.33. Now we are in a situation where we had a pretty good amount of volume at these elevated levels. You can see this node that developed, which is rather sizable considering how little time we've spent in this area here. Nevertheless, longer term than our 30-day time frame, at least, a trend line line in play still here. We are above our moving averages. They're all trending upward here. What really interested me is the RSI. We had this long, very gradual decline here. Yeah, but we broke above that trend line and pushed into the overbought area here. Now we're kind of losing that trend line a little bit, but the day is still very young here. We've got a lot of time before we close out for the week here. So keep an eye on this situation. Look to see if we can recover and make some new highs potentially.
Okay, as I look at this chart, one thing that I see is just the conviction associated with price, and you see that in these volume nodes over here. You get a separation with these small little areas. Again, the narrow areas of separation. You can see three possibly stacking up to set up and establish a fourth higher. Let's step back one more time here, Rick. You've got a longer-term chart where we can take a look here at, well, if we will, the monthly time frame and weekly, I meant to say weekly candle chart and longer-term chart. You can also see the significance of this breakout above 5,000 here in the most recent pullback, the test thereof.
Long-term gradual trend to the upside, shorter-term steeper trend here, pushing up beyond these levels here. RSI, the opposite situation, breaking through a downward trend line, pushing into the overbought level on a weekly basis here. So pretty interesting setup that we've got here.
Another chart communicating and a depiction of the high conviction type trade that we've seen to the upside as we head into the end of the week. Yeah, a little bit of a pullback. But definitely a trend that remains intact. Rick Cat helping us break it down, taking a look at the technicals. And thanks to all of our guests here today on the Future Show and you as well. Stick around. Lots to come this Friday here on the Schwab Network. Diane King Hall, Morning Trade Lives, headed your way next.
So what can you watch at the Schwab Network? Let's break that down for you. Every day from our studios here in Chicago and on the floor of the NYSE, we deliver more than 8 hours of live programming. We kick off every day bright and early at 8 a.m. Eastern with our Futures Show hosted by Ben Lichtenstein, breaking down commodity markets, futures, and technical trends. At 9 a.m., I'm in studio hosting our 2-hour opening bell show, Morning Trade Live. It sets the blueprint for traders for the day. We invite top analysts and investors to determine what's driving the early action, how to interpret the news, what's on the agenda for the session. Hey, Nicole, tell them about our shows at the NYSE.
Thanks, Oliver. Welcome, everyone, to our beautiful NYSE studio. We are here on the New York Stock Exchange floor, broadcasting live each day. I host the Watch List, which provides investors a fun midday update on the major news stories and themes. Best part of being down here is we are right in the center of the action. The energy is palpable. The sights are unmistakable. It's back to Chicago now. Jenny Horn.
Thanks, Nicole. Hi, everyone. I'm Jenny Horn, the host of Next Gen Investing. We all know how many new investors are beginning their trading journey and are eager to participate in the markets. And that's what I cover alongside Alex Coffey from 1 to 2 p.m. every day. We watch the hottest names, trending sectors, and under-the-radar stocks. Oliver, back to you.
For our active traders at launch, Fast Market steps up the engagement to a deep dive into volatility, options dynamics, and trading trends with former floor pros Tom White and Kevin Hinks. At 3 p.m., I'm here to guide you through the closing bell. We construct the best narrative explaining the day's action, which trends held or broke, and prepare for tomorrow's earnings and other market-moving events. Spend some time with the Schwab Network. I promise you haven't seen anything like it.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes, 40 customizable themes up to 25 stocks in just a few clicks.
Welcome to Morning Trade Live here on the Schwab Network. I'm Diane King Hall. I'm in for Oliver Rennick. Happy Friday, all. Let's get into how the market is shaping up. The theme seems to continue. As NVIDIA goes, so goes the market, with futures under a little bit of pressure to flat at the moment. S&P futures off by a few points after they crossed that key, a level of 5,500 yesterday, hit some resistance, and ultimately the S&P 500 finished lower yesterday. But again, we've got triple witching in order, which could lead to some volatility in markets. Dow futures under some pressure. NASDAQ 100 flat at the moment in terms of small caps. Looking like we may see a little bit of an advance at the open. We will certainly keep a watch on that. Let's take a look at some other asset classes that we're keeping our eyes on. The dollar continuing to hold above that 105 level. It's had some strength recently with some Fed officials out with some commentary this week. 10-year yield losing a little bit of ground here, down 3 basis points at the moment. Meantime, crude oil holding on to that level above $81 a barrel. You've got some fuel there, pardon the pun, thanks to, of course, demand increasing within that sector. Bitcoin losing a little bit of ground today. It's been flip-flopping this week. Bitcoin now down about 2%, trading around 63,000, below 64,000. Remember, yesterday was above 65,000. Coming up on the first hour of Morning Trade Live, we'll talk inflation and the Fed, how to position your portfolio for a potential rough landing. Plus, we'll dive into this morning's movers, including some analyst calls and big tech. And we'll go inside out on CarMax after this morning's earnings. You want to stick around for that. First, let's set up the trading day with our very own Kevin Hinks, co-host of Fast Market. Kevin, thanks for setting up the day for us. Always love how you set up, and honestly in the day too, because I love the insight coming and going. So I just mentioned triple witching on the docket today. What kind of volatility should we be prepared for?
Yeah, triple witching brings a unique opportunity to the markets. And how would I explain or describe triple witching? It's kind of like you're in a plane and you're about to do your descent, and the pilot comes on and says, buckle your seatbelts, it might be a little bumpy. That's what triple witching is. We're going to get to the ground. All these options are going to expire or be rolled, but it might get a little bumpy along the way. And with the 10-for-1 stock split in NVIDIA, the open interest in some of those big strikes like 120, 130, 140, massive open interest that could cause, like a moth to the light, right? It's gonna attract order flow and interest as Greeks, in this time, Gamma and Delta get very heightened on expiration day, and there could be massive swings as you get closer to 3 o'clock. So could be exciting, could be a bit bumpy. NVIDIA will add to that. So buckle up, Diane.
How much usually gets rolled over when we see a triple witching event, Kevin?
Well, here's what it is. Usually what determines that is the option in the money or out of the money, right? You may just let that option expire worthless if it's out of the money, but let's say in NVIDIA, if you have in the money options that you don't want to lose the stock on, then you might want to extend those and move those options to a later date. So usually in the money would get rolled, out of the money either gets bought and covered or allowed to go out worthless.
Okay, you just brought up NVIDIA. Obviously, it's had some softening this week, really since yesterday, and in terms of what it looks like in the pre-market. Is this kind of par for the course, or are we seeing just kind of a reset button happen right now?
You know, I've been doing this a long time, and there's no real direction to which way it goes. However, if it does go in one direction, it usually keeps going in that direction. But in my 40 years of watching these markets do this, there's no clear path. Probably 60% are bullish, 40% are bearish, something like that. But the main thing you want, the main thing you see in a day like this, Diane, is more volume, heightened volume, more rolls, like I said, for in-the-money options, more covering or just letting them go out worthless for out-of-the-money options. And that's calls and puts, obviously.
And for NVIDIA, could we see more around that with options tied to NVIDIA, more volatility around NVIDIA shares today?
Sure, you can, and here's why. Remember, the SPX, the NASDAQ, NVIDIA, a handful of other stocks are all overbought going into this expiration, so that could add more volatility to this. You just never know. But what you are going to see is volume. And in the middle of the summer, where that volume takes the market is anybody's guess.
Okay, and let's talk a little bit about the macro picture. It hasn't been a super busy week, but we actually have some economic data coming up. What are you watching out for, Kevin?
Well, today I'm watching the continued divergence between the U.S. dollar that's higher and 10-year yields that are low and seem to be going lower as, you know, Eurozone issues are starting to weigh on bonds, and there may be some bond or note buying here in the U.S. as protection. There's a bit of a risk-off feel going on right now with volatility, with bond market. We'll see if that follows through. But the dollar, which used to not be in the risk-off camp, now it's kind of in the risk-off camp, is also higher. So kind of a mixed message between yields and the dollar. We'll watch that play out as always.
I noticed that, Kevin, especially because, you know, we saw yields tick up yesterday, but it tick a little lower today.
Yeah.
Let's talk a little bit about housing. Now, yesterday we saw some weakness in housing starts that came in lighter than expected. We have some existing home sales data on deck. You know, when we talk to different voices, they say housing can be a little bit isolated because of just different factors going on there. What are we watching out for?
Well, you know, the yields, the drop in yields that we've seen in the U.S. should spur better housing markets, right? Like a week ago, mortgage apps jumped to big numbers. This week, a little more muted, a little less than we thought. So what is that? How do you connect the dots? Is that the U.S. consumer getting weaker? Is that the summer months and kind of a lull there as the overall market kind of rests during the summer? Is it seasonal? It's a little bit tricky, but yeah, people were surprised how weak that is. Because in general, at a macro look at housing, we don't have enough housing in this country. So when you see starts and permits come in so weak, it's a bit alarming on maybe the strength of the U.S. consumer and why builders are backing off in terms of starting homes or applying for the permits. So, yeah, that was an alarming number. We'll keep watch. And what that does for a trader, Dan, now it's on the radar. Now housing is on the radar, and traders are watching for the next data point to see if there's any streak starting there, any trend.
Okay. And Kevin, just to bring us back to the top of our conversation, so my takeaway is we should look out for some volatility in the last hour to last half hour of the trading day, right?
Yeah, it could be the last hour. It could be during the day. It's whenever these big options that are out there, and there's a lot of them. There's big numbers, especially in NVIDIA. Yeah, it could cause some movement in the market. Absolutely. Remember, yesterday, on Thursday of expiration date, NVIDIA had about a $10 range. So watch for more of that today.
All right. We'll keep our eyes on that one. Kevin Hinks, co-host of Fast Market. Thank you, Kevin.
Yes.
Now we turn our attention to the latest on the morning's biggest mover. For that, I want to welcome in Jenny Horn. Sarepta Therapeutics soaring more than 30% this morning. What's the latest here, Jenny?
Yeah, good morning, Diane. And I have to say that I had to like triple check to make sure I was seeing it right. I saw shares jump as much as 38%, so actually nearing 40% here. We'll have to see, obviously, where we open. But after the biotech company did say the U.S. regulator has approved an expanded indication of its treatment for a rare muscular disorder. It's a form of muscular dystrophy. So the FDA will now allow this drug to be administered to boys at least 4 years old with confirmed mutation of the DMD gene, according to the statement from the company. We do know that this is a genetic disease that does primarily affect boys and causes muscular degeneration as well as weakness, and often appears in early childhood. There are about 15,000 cases in the U.S. according to the Muscular Dystrophy Association, and most patients do not survive past their 20s. So it's a rather dire treatment. I think that's obviously going to be well utilized to prevent so many of those deaths. But the expanded approval for boys who can still walk and those who can't. The FDA gave traditional approval for its ambulatory patients and accelerated approval for its non-ambulatory patients. But this last year did receive the accelerated FDA approval for the gene therapy for children ages 4 to 5 with this disorder. The accelerated approval does give patients now earlier access to the promising new treatments, while the company does continue its clinical trials to confirm the drug's continued benefits. They did suffer a setback, though, however, last fall when we saw data of the treatment helped patients' movement and walking ability, but did not actually produce statistically significant improvements versus the placebo in these ambulatory assessments after just 1 year. So it has had its fair share of roadblocks and hurdles, but it does seem like this was met, obviously, with a pretty warm reception this morning, with shares climbing as significantly as they have. And analysts are reacting as such, and I think appropriately so, because, I mean, the stock has just gained so much value pretty much overnight. We are seeing so many of these names. Oppenheimer raised its price target to $215 from $180. B of A is another one, $213 from $166. Mind you, we closed yesterday at $123.50 a share. So to see now these price targets well above $200 is sort of astounding, but we did climb to as high as just shy of like $176 a share. So we're moving here. And again, we'll have to wait to see where we open. But a lot of times these biotech names are capable of making these moves on the back of any sort of regulatory FDA approval.
Yeah, we've seen that before with a variety of drugs and therapies when you see that green light from the feds. But what about headwinds? What are the headwinds that, you know, could be facing the company or previously?
So what I always tend to think of, like with headwinds, when you see a degree of move like we have this morning, is now there's a lot of expectations riding on this treatment. I know we did get this FDA approval and it did receive accelerated approval just last fall, but like I mentioned, there have been some setbacks. There have been times where they've seen not meaningful treatment and that was able to sort of withstand. So I always think that when you're capable of making a 30% move to the upside, any of these massive moves, then anytime there's any sort of snag in a treatment, we could see shares also fall 30, 40%. So I always say mind the volatility of these names. Now there's a market maker move of around $20. So market's expecting $20 jump in either direction. But again, I think that anytime there's this much banking on one specific treatment, you're then at risk to see, I mean, some degree of snags in the overall process. As we know, it's not a seamless process to get a lot of these drugs widely approved here in the U.S. So I would say that while it's good news today and we can celebrate today, be mindful that this is still relatively experimental. We're still in the approval process of this treatment and still very limited to certain control groups.
No, you make a good point about like what happens with approvals, because Pfizer had tried to embark on a therapy within this space as well, and they weren't able to cross that hurdle, and they certainly, you know, shares suffered as a result. So you make a great point about it. I mean, we know it's an experimental gene therapy, and one of the issues that it also was facing is the cost of this. We'll see what happens now that it's crossed a threshold in terms of the FDA approval. Jenny Horn, thank you for the insight on the latest with Sarepta Therapeutics, stock up more than 30%. Thank you, Jenny. Coming up, we'll focus on the macro picture, why investors should prepare for a, quote, rough landing in the U.S. economy. That's next on Morning Trade Live. Stay with us.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device, for free.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Welcome back to Morning Trade Live. I'm Diane King Hall. Let's focus in on the economy as we lead up to the opening bell on Wall Street. Joining us now is Brooke Thackeray, research analyst of Global X ETFs. Thank you so much for joining us this morning, Brooke. All right, let's set the stage here today. We kind of talked coming into this about a potential rough landing. Before we get to exactly what that means, talk to us about your interpretation of where the Fed's position is in the context of some of the economic data points that we have recently.
Well, they're in a tight spot. I mean, some of the headline macro numbers, the inflation number is quite reasonable. It's 3.3%, so it's higher than what's expected, but GDP is still kind of strong at 2.9%. And unemployment right now is still low at 4%. I mean, there are other indicators that maybe it's not that strong, but overall, as an aggregate, the numbers aren't that bad. But the soft numbers, we're seeing this real erosion take place with the consumer. We're seeing credit card debts go up. We're seeing repossessions go up. We're seeing, a bunch of these survey data coming out and saying, hey, the economy's not in that strong of shape. And we're getting that feedback from the CEOs on conference calls as well in the retail sector. So the numbers are still showing, hey, maybe we're still okay, but we're seeing some really undertows really taking place here that the economy's not so good. So the Federal Reserve can't, it's trying to fight inflation right now. And the numbers are really, we can start parsing them and pulling out a little piece here and there and start talking about what is it, shelter? Should we pull out energy? But overall, we haven't seen this reliable downtrend in inflation. And the Federal Reserve is intent on fighting inflation right now. So we could see that continue, even though we're starting to see this erosion of the economy. So it's a tough place right now for the Federal Reserve, but I think they're still going to hold here. Right now, the financial markets are pricing in 2 rate cuts for the year. I think at some point they will move, but we have that lag effect because don't forget the monetary policy takes 18 to 24 months to have an impact. Federal Reserve started raising rates in March of 2022. So we're just starting to get to that point now, where the first cuts are actually having that full impact. And they stopped raising in July of 2023. So we're starting to see, we still have a long way to go for all those rate cuts to really work its way into the economy. And I think this is a really difficult task for the Federal Reserve. I think it's already baked into the cake that we're going to see the economy slow down here. And I don't think we're going to get a soft landing. I don't think we're going to get a hard landing. I think we're going to get a rough landing. So somewhere in between.
Okay, can you extrapolate a little bit about what you mean by rough landing? What's that somewhere in between?
What that means is we get into, I think we will see a recession in 2025. I think it's going to happen. I think that's no matter what happens, even if the Federal Reserve starts cutting at this point, slowly, I think we'll still go there because of what's happened in the past. So I do see a slowdown taking place. I do see the Federal Reserve cutting rates on that. So, but I don't expect a crash in the economy because we have government spending up huge. They're spending a huge amount of money here, and I think that's going to continue. So that's artificially propping up the economy here, and I think because it's going to continue doing it, it's going to be this, not a hard landing per se. So I do see a medium type of recession where we do see some sort of a tangible economic slowdown. I do see unemployment starting to rise here from 4%. Right now, we're at the bottom end of where the acceptable range is from 4 to 6, but I see that continuing to tick up. And I think we're going to start moving up higher and higher, and that's going to start to have an impact. So I do see a medium type of recession.
When you talk about, let's go back to the points you were making about inflation earlier. There has been talk about, should shelter still be kind of a part of the puzzle when we look at inflation, especially because of how high shelter costs have been compared to other metrics when we measure inflation. What do you think the Fed needs to do, or what measures do you think the Fed needs to take to cool inflation further, or is this just a waiting game?
I think, well, first of all, they're still doing quantitative tightening. They're still selling $25 billion a month of government bonds and $35 billion of the mortgage-backed securities. So they slowed that down. I think they need to continue with that because their balance sheet right now is extremely high. It's at $7.1 trillion. So they need to continue to try to work that down. And I think the best approach to this at some point is to start maybe do one cut and really announce that they're going to pause and really wait for that to digest and wait for a while before that really gets embedded into the market itself. I think investors really we're used to seeing the rates go up, tick, 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 higher and higher really quickly. And I think that's the expectation from investors. Once the cycle starts, that the Federal Reserve will really cut fast. If that happens, that means we're in real trouble. I think the Federal Reserve wants to really have a glide course where they're just gliding it down slowly and trying to work this as well as it can. But if we start to see that what investors want, that means the economy is really starting to erode.
Who doesn't want to glide? It's like when we compare that to, for instance, a plane landing. But let's talk about a little bit about positioning in the context of an economic slowdown. What's your recommendation of how to get defensive?
Yeah, I think, if you take a look at the overall market, I think that it could have an impact on the stock market. We are seeing a lot of hype around some of the tech stocks, and that's an independent situation to what's going on because they're sort of defying gravity here, and that can keep going even at high rates. But I think overall we are going to see some sort of slowdown in the marketplace with stocks. And I think the best positioning is more of a defensive positioning. Bonds in this environment will do well. At least in the short term, because the Federal Reserve would be cutting rates, and at the same time, we're having an economic slowdown. So bonds would benefit. I think gold can do well as well in that environment. We're seeing a real attractiveness for a lot of investors, particularly overseas, buying gold as a replacement for bonds as well. So I think that those two assets are probably solid cores in this next cycle as we start to slow down.
Earlier, you mentioned credit concerns, basically about consumers, their level of debt that they're holding. Delinquencies have been on the rise. You've seen credit card balances at record levels. What risks are you paying attention to when it comes to the health of the consumer?
Well, yeah, there's no question that the bottom end of the income spectrum is really suffering at this point. We're seeing consumers really trading down. We're seeing that, in Walmart talking about in their earnings as well. We're seeing the discretionary side of spending really start to tighten up here a little bit. And so, we really haven't seen it affect travel so much yet, but we're starting to see some warning signs in that area. So I would expect that to roll out slowly into travel. So far, the bookings on a go-forward basis are still quite decent. And that has a lot to do with the way that the COVID money was distributed. And so you had a lot of the upper income earners, business owners getting a lot of the money. And so they're still spending the money, although it is running out at this point. So one of the things I'd be watching out for from a credit perspective is that upper income group. If we start to see travel start to go down, that's probably the next domino at some point. And that basically says, hey, the whole discretionary side really is drying up here.
All right, and let's talk a little bit about the labor market, because you mentioned this earlier as well, and what you're paying attention to there. Yes, we saw unemployment tick up to 4%, but overall the labor market has been holding up. We're starting to see a little bit of kind of cracks in the armor with weekly jobless claims, but even this week, it was still, not at a level that's necessarily sounding the alarm. But what are you paying attention to under the hood when it comes to the labor market picture?
Well, it's interesting that Powell in the last press conference actually mentioned that maybe the BLS numbers weren't quite as good as they seem. So there's a bunch of other numbers out there that say, hey, the employment picture is not quite as good. And if you take a look at the household survey data, that's actually been losing jobs versus the non-farm payroll data, which has been gaining jobs. And don't forget, with the non-farm payroll jobs, each part-time job is counted as a job. So if somebody loses a job, full-time job, and gets three part-time jobs, that's counted as a gain of 2 jobs, which is not a healthy sign. And so what you see going before a recession is you actually see employment being fairly strong when it's measured with the non-farm payroll number, and how it works into the unemployment number. It's because it's more part-time jobs are taking place here. And so don't forget, employment's a lagging indicator. So, there's a whole bunch of other stuff going on here, but we are starting to see some cracks. There's no doubt as far as that goes. Whether we're looking at jobless claims, that's actually, really indicating that we're starting to see a slowdown as well. So just the headline number there for the non-farm payroll number is looking good, and the employment number is still low, but there's a whole bunch of weaker numbers underneath.
Okay, speaking of lags, obviously we know when the Fed makes a move on rates, there is a lag. If the anticipation is for a cut or two by the end of the year, when is the expected effect of that? Let's say it's in September or December.
Yeah, that's a tough one because it's an election year as well. And they will, if they have to, make an adjustment and lower the rate if they have to. Right now, so we're looking at possibly, I would guess they might do something in September. So before the election, because the next opportunity after September would be the day after the U.S. election, which is kind of interesting. So they might actually make one action here and then pause and really communicate that they're going to really pause at that point and wait. So that would be my expectation at this point. And we're starting to see some central banks around the world make some cuts here. And it's going to be interesting to see how they follow along too. If the Federal Reserve really pauses here, it's going to put some pressure on them to keep up their rates here and not cut too fast.
All right, well, that will certainly be what we're watching for. It is a tricky year for the Fed. Brooke Thackeray, a research analyst, Global X ETFs. Thank you, Brooke.
Thank you.
Coming up, you got it. We've got the opening bell on Wall Street, plus our morning movers. Stay with us.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
That is the sound of the opening bell on Wall Street. It is Friday. Happy Friday, everyone. We'll see how things are kicking off in just a moment here on Friday. It's been a holiday shortened week. We saw moves to the upside earlier this week. We saw some deceleration yesterday in the market after coming back from a holiday, a newish holiday to the holiday calendar. Seeing a little bit of weakness again in the S&P 500. Yesterday it climbed above a new level, 5,500. It's been backpedaling a little bit since that. Now down 9 points at the moment. Anything can happen today. It's triple witching. NASDAQ 100 under a little bit of pressure as well, down 33 points. Dow has flipped to the upside. It's better by 20 points. Dow finished higher yesterday. Small caps flat at the moment, off just a point. So we will see what occurs through this week. The market's still on track for gains for the week. But let's take a look at some of the morning movers. Joining us now for that, senior markets correspondent. We've got Renita Young in action. So Apple's in focus today. Renita pulled back yesterday, but we've got some bullish sentiment around this, right?
Absolutely, and coming primarily from Bernstein this morning, who boosted its price target on Apple to $240 from $195 and kept it at an outperform rating. Now, this analyst notes how Apple has outperformed the S&P 500 since second quarter earnings, not the full year, but since second quarter earnings. And that includes a substantial gain after the Worldwide Developers Conference happened on June 10th. And the analyst believes that shares are no longer inexpensive versus what they have been in recent history. The primary reason, Bernstein believes, is these investors being incredibly enthusiastic about Apple being an AI leader now. A lot of times, or a lot over the past few months, we wondered what was Apple's AI play. And now that we have it, these investors believe that Apple can actually become an AI leader. In fact, Bernstein said that it's increasingly convinced that Apple will be an AI beneficiary. I don't know to the degree of NVIDIA or not, but certainly so. It sees risk, however, over at Bernstein that the benefits could actually take longer to materialize than some bulls appear to believe. Why? Because many of the features for Apple's Apple Intelligence rolling out of the next year, they're only going to be in English. They'll only work in English, and that potentially shuts out a huge market and potentially pushes out some upgraders to the iPhone 17 cycle. That's the word from Bernstein this morning, but still bullish on this stock, keeping it at an outperform rating and boosting the price target. Diane.
Well, Apple certainly had to play catch up, on obviously the AI front, because there were all these questions from last year through this year about where was Apple, where is it on AI, and they've said, oh, we've been in the game, but investors wanted to hear more, and now they finally came to the plate with Apple Intelligence. So, you know, there's still some questions around it, but the stock has certainly come back and regained some ground since April, right, Renita?
It absolutely has. You know, since April, it's gained, and it has been outperforming the S&P 500 since those second quarter earnings. But we'll see how it continues, whether or not Apple Intelligence takes it through the roof or not.
Yep, that will be one to watch. Apple up nearly 14% year to date. Renita Young, thank you. For more movers, we want to welcome in senior markets correspondent Kevin Green. Let's stick with the mega caps, though. Kevin, KG, you got a bullish note on Microsoft here. What's the latest?
Yeah, we are seeing the shares pop to the upside here, and this is after Citi actually raised their price target on Microsoft to $520, and that's up from $495. And they also keep their buy rating on the shares here. They're really kind of focusing on two areas. One is going to be OpenAI's revenue growth. They do believe that that's going to be a positive tailwind here when it comes to Microsoft's growth, but it also is going to be positive when it comes to Azure. Now, you just have to keep in mind, and they do warn that the market might be underestimating the losses that Microsoft will incur due to OpenAI's non-operating expenses, but they do believe that the estimates moving forward, especially when you're looking at 2027, is going to be positive. So they did adjust their 2027 price targets and as well as adjusted earnings per share targets here. So overall, this is still a bullish note. Microsoft is catching a little bit of a bid here today, and we have continued to see this focus around AI, especially when you're looking at OpenAI and how this is going to really transition the market over the long term. We are seeing Microsoft up about 0.8% in the session here right now. Let's see if it's going to be able to hold these gains, but a nice little rebound from a little bit of a pullback that we saw on an intraday basis yesterday. So a positive note to say the least here, Diane.
And it looks like it reclaimed its title of most valuable company with some of the weakness that we're seeing in NVIDIA.
Yeah, we're just seeing this kind of rotation between Apple, Microsoft, and NVIDIA on who's going to be the #1 market cap weighted stock here in the S&P 500. But once again, if you're kind of looking at it from a totality standpoint, for the most part, they're all either reaching all-time highs and or near all-time highs. So that's still a positive sign when it comes to the broader market because of the weighting that they have for the S&P 500. So it continues to be a battle. I'm not sure if we should actually put up those headlines quite yet until we start seeing a little bit more of a separation between these companies. But overall, they're all looking pretty good when it comes to the positive flows going into their stocks here.
Yeah, it looks like it's a three-horse race between these companies, these mega players, and you know, who knows? Like you're right, it would probably be a photo finish by the close. Let's pivot and look at another stock that you've been, another company we've been watching. It had faced trouble since last year, but regained some ground. Nike. It's got earnings on tap next week. What do you have on Nike?
Yeah, so Nike was trading about 1.2% higher in the early trading session here, and we are seeing Oppenheimer actually upgrading the stock to outperform from market perform here with the new price target of $120, and that's up from $110. Now, obviously, Nike has faced some significant challenges when it comes to sales growth, as well as lackluster sales when it comes to China. The market really thought that there was going to be a strong rebound there, but they believe that a lot of the headwinds are already being priced into the stock, especially the current multiples that it's trading at right now. And the stock appears to be de-risked at the moment here. They did reinstate Nike as a top mega cap pick, and they also highlighted the fact that Nike's leadership has really highlighted some cost realignment strategies that's going to help them on the bottom line number here. And once again, it hasn't been a great stock as you're kind of looking at the chart, but it is kind of consolidating here. And if we have some good news coming out of earnings or some good China sales that are going to be reported here, this could be a stock that does try to pop to the upside as the market is trying to look for value over maybe some of these growthier names that are trading at really expensive multiples.
I mean, so the question is for Nike, because it had those inventory problems before. It also has the problem of going up against now the popular names when we think about Hoka, On, et cetera. What should we be watching out for when it comes to Nike?
I think over the next 6 months, just hearing from leadership how they would like to manage their direct-to-consumer strategy, that was a tailwind for them about a year ago. And then they kind of pulled back a little bit because of some of their third-party sellers were a little bit upset regarding their strategy. They're kind of competing with their own customers. And so are they going to really double down on the direct-to-consumer because that is a more profitable business when you're looking at the margins? Or are they going to try to have more of a finer balance within this market? I think that's going to be the key area. And I think that's another reason why we saw the stock sell off, not only just because of slowing sales growth, but also the murkiness when it comes to their outlook moving forward and how they plan to drive top line growth when it comes to revenue.
All right, let's switch to another sector. We're covering all our bases here this morning. You're looking at Freeport-McMoRan. They got an upgrade. What's the latest here?
Yeah, so we're seeing the shares down about 1.2%. Now, that might have changed as the market has opened here, but we have Morgan Stanley actually upgrading the stock here to overweight from equal weight with a price target of $62, and that's up from $49.50 here. Now, they believe that the broader market, or when you're looking at the overall metals market, the physical market, they believe that there's going to be some upside because of the decarbonization campaigns that are going out there, as well as electrification needs, and that could be a tailwind for them, especially when you're looking at the copper market. They did also highlight the fact that the Grasberg agreement renewal for this company, which is their number one profitable mine, has been extended by about 20 years. So that will also be a tailwind for this company as well. Now, Freeport-McMoRan, as well as some of these other metal stocks, have caught a bid here over the last couple of months, as well as the commodities themselves, silver, copper, as well as gold. Now, the big question here, Diane, is going to be, are these commodities going to be able to maintain these prices, which will then be profitable for Freeport when it comes to margins here, or are we going to see a reversal? I think that's going to be the biggest key area for them as they report earnings in the next couple of weeks.
And then what's the levels that we should be paying attention to for Freeport?
That is actually a very good question. I actually have not looked at it too much here, but once again, when you're kind of looking at these trending markets, you kind of want to look at Fibonacci retracements between the lows that we have seen and the highs that we have seen as well. So one thing to kind of know, if you're looking at that 50% retracement level, that might be that key range to be able to try to retest here in the near term. But once again, it's going to be really focused and determined on the fact that commodity prices can remain. So if you're looking at a 50% retracement, that would be around $44.85. If not, and it is able to hold this area of support at $57, and we do see a pop back to the upside, then it could try to recapture some of the recapture the highs that we've seen this year at around $55.24. So it's kind of in the middle range, trying to make a decision as to either breaking to the upside or breaking to the downside right now.
All right. So let's pivot and look at the airlines. There's a potential strike on deck at American Airlines. I remember last year that was really like the summer of strikes, and you had that across sectors. What are we watching there when it comes to American Airlines?
Yeah, American Airlines might be feeling the pinch here a little bit. It is reported that the Association of Professional Flight Attendants has announced that they have not come to an agreement with the company at this point in time, and they have started to make maneuvers in order to potentially strike because of the proposals that they have seen coming from American Airline executives here. Now, the flight attendants cannot actually strike until the National Mediation Board grants them permission, but that would be formally the last step in order for them to do so. Now, Diane, we kind of see these situations over the last couple of years. When you're looking at labor costs, it is one of the bigger inputs when it comes to expenses for a lot of these airline companies, and it does squeeze margins. But we generally, and maybe this is going to be a different case, but we generally see a final hour type of deal that is being made, or potentially an extension to talks in order to avoid any type of disruptions when it comes to flights, which would have a dramatic impact, not only when you're looking at American Airlines, but also the overall U.S. economy.
Yeah, American Airlines has had some trouble this year in general, whether we're talking about these labor strikes or even, they had cut their outlook earlier this year. Worries about demand, and then they tried this new pricing strategy. So, it's certainly one to watch. The stock is under pressure at the moment, off 1%. We're looking at all the airlines down a little bit. Anything else, any final thoughts, Kevin, on any of these stocks, whether it's American Airlines or any of the other ones that we talked about, Freeport, et cetera?
I would just kind of keep your eye out on Freeport. I mean, there is a significant amount of copper ore that is hitting the market, and that has been kind of the narrative over the last, let's say, month and a half, 2 months, that there's this huge shortage in copper, which is, we are seeing a shortage, but we are seeing some supply hit the market. You can see that with the London Metals Exchange inventory supply levels actually increasing last week. And so if we are seeing that supply hitting the market, it could depress prices, and that could be a little bit of a headwind when it comes to Freeport-McMoRan because of some of those commodity prices maybe retreating, like silver, copper, and gold.
All right, from metals to mega cap tech, Kevin Green covers it all. Thank you, KG. Coming up, we'll go inside out on CarMax, its earnings, and trade the company after the report. Morning Trade Live will be back after this break.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Trade Live. Time now to go inside out on CarMax earnings. Joining us now is Garrett Nelson, Vice President, Senior Equity Analyst, CFRA Research. Garrett, thank you so much for joining us this Friday. Happy Friday, first off. So CarMax, they reported adjusted EPS 97 cents a share, revenue topped $7.1 billion. The numbers better than expected. What stood out to you in terms of its quarterly report?
Sure, thanks for having me. The release was a little bit better than expected, and they beat both on the top line, where the revenue came in about $20 million ahead of estimates, and on the margin line, where the gross margin expanded by about 50 basis points year over year, coming in slightly ahead of consensus. So, I think it was better than was feared. If you look, EPS was still down by 33% year over year, but the good news is that it looks like comps are going to improve looking ahead over the next 3 or 4 quarters. But in our view, there's still a lot of headwinds surrounding the used car market. So, we put a note out this morning. We stuck with our hold rating and $70 12-month price target.
So you have a $70 12-month price target. You have a hold rating on CarMax. What are the headwinds that's causing concern for you?
Sure. First, elevated interest rates. I mean, we came into the year, the expectation was for 6 Fed rate cuts. Now it looks like there might be only 1, maybe none. But so that has really, this higher for longer interest rate environment is really weighing on their sales volume. And then also inventories. If you look, inventories in the U.S. car market are at about their highest level in 4 years. And so, that is something that auto dealerships are really fighting, leading to a more subdued pricing environment than they've enjoyed over the last few years. So, we look at the stock, trading at about 19 times our earnings estimate for next year. And we just think the risk reward here is pretty balanced. I understand, the stock it has pulled back a lot from the mid 80s level where it was a few months ago, but we still think it's a little too early to be buying the stock.
One thing that has happened recently that we've seen in terms of used vehicles, we've seen some increase in demand for used vehicle. I mean, consumers have been holding on to their cars longer, which means, people are going to eventually have to upgrade. Would you see that as a benefit to CarMax?
Yeah, it should be. And certainly we're seeing more strength in used vehicle sales than in the new vehicle market, where new vehicle sales have really plateaued around the 15 million to 16 million annualized rate. And used vehicle sales, obviously a lot of consumers continue to struggle with inflation. And so used vehicles being much lower cost provide better value. And so there's been an uptick in sales volume for used vehicles, but still there's an inventory issue, and we think that's going to keep a lid on pricing.
Okay, so the inventory issue, one of your concerns with regard to pricing strength. What about the competitive landscape, CarMax and competition from, say, Carvana? Is that a concern?
Certainly is. But one thing CarMax did is a few years ago, they made very heavy investment in e-commerce. And so now they have the ability, all the same abilities that Carvana has in terms of the ability of customers to buy vehicles on their website and having that vehicle delivered right to their home. So, CarMax was pretty quick to respond to the threat from Carvana by rolling that out nationwide, which they have now done across all their stores.
Let's talk a little bit about, I want to go back to your price target and the hold rating you have on it. What changes that opinion for you?
I think it's just greater visibility regarding interest rate cuts and really looking at that as a catalyst for higher sales volume. You look, auto dealers have also been increasing incentives pretty dramatically as inventories have risen. So, really looking for some change in the fundamental situation with inventories and with interest rates. Start to get some visibility as to how many cuts there might be in 2025. And really, looking at that as a potential catalyst for higher auto sales, both in the used market and in the used vehicle market. So, but as it is, inventories have been moving in the wrong direction. That's keeping a lid on pricing, and dealers are coming out having to offer greater incentives. And so, we're looking for some kind of change in the fundamental picture.
Okay, looking for a change in the fundamental picture. Any final thoughts on CarMax after its latest quarterly report, Garrett?
One positive is they bought back a lot more stock during the quarter. They bought back 100 million of stock during this first quarter of their fiscal 25, which is actually more stock than they bought back during all of fiscal 2024. So, that's one positive. We just think it's a little too early, and the valuation isn't compelling enough to justify a buy at these levels.
Okay, so not quite justified for you. Shares are higher today. We will see who has it right. Garrett Nelson, CFRA Research, thank you for your insight on CarMax. All right, let's trade this with Tom White, co-host of Fast Market. So, Tom, what are you seeing in terms of in the options market for CarMax?
Yeah, Diane, implied volatility levels crashing post the event risk, and also the fact that it's moving up over 2%. So how do you play this? Based on Garrett's price target of about 70, stock's trading about 73. So I looked at something neutral here, where you can just take advantage of time decay or theta on this type of option strategy, where you expect it to remain in a specific range. So going out to the July monthly series here, they don't have weekly options. And just selling an iron condor, we sometimes call this a short iron butterfly on this type of strategy, where going out to that July monthly cycle, 28 days to expiration, where I'm going to buy one of the 65 strike puts, sell one of the 75 strike calls and 75 strike puts. So you're selling that straddle there on the 75 strike, and then buying one of the 85 strike calls. So in essence, you're selling a 75-65 put vertical and selling a 75-85 call vertical. That makes up this strategy. You're collecting a credit of roughly about $5. What that means is that's what the max potential reward you could have on this trade is $5 if it settles at or near 75. But you've got a nice wide range between about $70 and $80 to the upside where the stock can remain over the next month and you still be profitable on this type of trade. The stock's traded in a range of about $67 to $77 over the last month and a half. So this takes advantage of more consolidation in the stock over the next 4 weeks.
All right, let's pivot to a competitor for CarMax, Carvana. Shares are under some pressure today, but it's been off to the races this year. I mean, this was a company that investors had really discounted previously, but it made a comeback. You have some analyst support behind Carvana today. Evercore ISI raising their price target on Carvana to $118 a share from $111 this week. You have other analysts coming on board. Needham, they reiterated a hold rating, though, on shares of Carvana. So a little bit bared. They lifted their price target to $110 a share. So what are you seeing in the options space for Carvana?
Yeah, it's been opposite. CarMax down 4% this year, and Carvana up over 105% so far this year. So it's been a tale of two stocks in this segment. One of the key things with Carvana is, maybe that's why we're seeing the rally, is the big short open interest in here. They got short open interest of about 24% of the float out there. So you have to be careful with this one, but maybe that's what's propelling this one a lot more than CarMax. And you mentioned the rally that we've seen in December of 2022. The stock was trading under $4 a share. So it's had a great comeback. They've paid down debt quite a bit, which has been beneficial. They've shortened some of the duration on their debt also. While their margins have slightly increased, there's still some headwinds here. So I looked at a strategy, takes advantage of a move down. Now, they report earnings on the 18th of July. So I want to avoid that earnings event because that could add some potential volatility and moves in the stock. But I went out to the July 12th weekly cycle. Only 3 weeks to expiration, and I looked at something downside in this one because of the massive rally that we've seen. Got overbought here recently before the slight pullback that we're seeing. So going out to the July 12th weekly cycle, buying a put butterfly in here, and I skewed it a little bit where I can take advantage of if the stock moves 2% lower or more, everything is profitable on it. So buying one of the July 12th weekly 109 strike puts, selling two of the 104 strike puts, that's where you want it to go, and then buying one of the 102 strike puts. You're paying roughly about a $2 debit for this broken wing butterfly or skewed butterfly to the downside. That takes your break even down to 107 over the next 3 weeks. That's only 2% below the current share price in there. So you don't need a massive move in this stock to the downside. And if the overall market starts selling off, this will probably participate to the downside. But I think the key with this one, when you're taking a directional bias on a stock, is watching earnings. So this trade, because it expires before earnings, you're going to avoid the additional volatility. But this is definitely a bearish look at Carvana, but not overly bearish. You want this thing to grind lower anywhere from 2 to 5, 7%. But anything below that break even of 107 is going to be profitability.
All right, well, that was an example trade on Carvana, and before that, an example trade on CarMax. Certainly one of the headwinds to watch that Garrett mentioned earlier, interest rate risk. Tom White, co-host of Fast Market. Thank you, Tom.
Thanks.
All right, we've got the second hour of Morning Trade Live coming up next. We'll go through the latest economic data with Ben Lichtenstein, and our morning trade is Micron ahead of next week's earnings. Morning Trade Live will be right back after this break.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
All the need-to-know info from every trading day. I'm Renita Young. Earnings, data, the biggest headlines that move the market, all condensed into a few minutes. Download the Schwab Network app and join in on the latest market trends, available anytime, anywhere, on any device, for free. Recap your trading day with the wrap, right here on schwabnetwork.com.
Welcome back to Morning Trade Live. I'm Diane King Hall. I'm in for Oliver Rennick. Happy Friday again. Let's take a look at markets, how things are shaping up at this hour. Looks like there's some weariness when it comes to the bulls. S&P 500 still a little lower, off by 9. Dow holding on to a gain, 48 points. NASDAQ 100 off by 55. Small caps also still lower, off by 7 points or down by 0.3%. Looks like some bullish buyer fatigue that we're seeing at the end of this week, although market's still on track to post gains for the week. Also ahead on this second hour of Morning Trade Live, the morning trade is Micron, ahead of next week's earnings. We'll preview the numbers. Plus, the team from FTSE Russell joins us to discuss this year's reconstitution. And the chart master will preview next week's earnings reports from Carnival, FedEx, and General Mills. All right, we've got some fresh economic data to dive into. We've just got a bunch coming out right now. Ben Lichtenstein joins us with the latest. So let's start out with, we've got a slew to get into. We've got PMI, we've got home sales to get into, we've got leading indicators. I know you're getting all of this breaking right now, Ben. Let's start out with the PMI composite flash data. What are we seeing?
Okay, well, that was released a little bit earlier, Diane, this morning. That came out at 9:45 a.m. Eastern. But taking a look at those numbers here across the board, higher than expected and above prior levels. So a little bit of uptick in the S&P Global. U.S. manufacturing PMI for the month of June, which came in at 51.7, and expectations were for a reading of 51. Diane, prior 51.3. Just kind of looking through some of the components associated with this number. The global composite PMI coming in at 54.6. 53.5 is what analysts were looking for. 54.5 was the prior reading. The services PMI at 55.1, so a bit of an uptick there from what analysts were looking for 53.4, prior 54.8. Again, all these numbers coming in higher than analysts' expectations and higher than expected. So a bit of an uptick there in terms of the PMI data, nothing maybe to be too concerned about, but this kind of in line with what we've seen, right? An economy that in some areas is starting to show signs of weakening, in other areas remains very strong.
I was just thinking that. I was thinking that it kind of leads to the mixed messages that we've been getting all week on the state of the economy. We had weaker retail sales. We had, some weakness in the housing market yesterday, and now we're seeing some signs of strength when we look at this PMI data. But speaking of the housing market, we have some new existing home sales data that just hit the tape. What are we seeing there in terms of those numbers, Ben?
We do. I'm trying to get an actual quote here from from Lawrence Yu here, but having a hard time finding that right now. But we do have existing home sales, which we know has been and continues to be an area where we've seen kind of a stickiness, right, as homeowners don't necessarily want to move out of that 3% or maybe even lower in some cases mortgages into a 7% or higher, for example, type scenario in terms of what we're seeing right now. So everybody's kind of sitting on their homes, and here it is. The release actually just came out here. It looks like another number where we saw a negative reading, so down 0.7. Lower by, again, 0.7 in the month of May. Median price, sales price reached a record high, though, Diane. Again, kind of an indication of that condition that we're seeing where existing homeowners don't necessarily want to get out of those lower rate mortgages. That new record high is $419,300. Again, that is the median sale price reached for the U.S. record existing home sale. As mentioned here now, so this number coming in down 0.7 to a seasonally adjusted rate of 4.11 million. Sales descended 2.8% from a year ago. Mentioned here that a median sale price at $419,300. That jumped 5.8% from May of last year, and the 11th consecutive year, or I'm sorry, 11 consecutive month over month. I'm sorry. That was the 11th consecutive month over year price gains that we've seen. So 11th consecutive month with year-over-year price gains. Now the inventory unsold homes grew by 6.7%, Diane, from the previous month to 1.28 million at the end of May, the equivalent basically of 3.7 months of supply at the current month's sales pace. Just taking a look here again, Lawrence Yun, I might have said Lawrence Yu, I'm sorry, Lawrence Yun, he is the NAR chief economist, said that eventually more inventory is going to boost home sales and tame home price gains in the upcoming months. He talked about increased housing supply, how it spells good news for consumers, but for those who want to see more properties before making purchase decisions. But he also talked about how home prices reaching new highs are creating a wider divide between those owning properties and those who wish to be first-time buyers. Young adding that the mortgage payment for a typical home today is more than double that of homes purchased before 2020. Still, the first-time buyers in the market, they said, understand the long-term benefits of owning a home. So, yeah, I think, again, a reflection of what we see. I did notice this number, U.S. existing home sales, Diane, just kind of a fun fact for you. In 1978, they were at 4.09 million. In 2024, 4.01 million. And as I take a look, keep in mind, U.S. population back in 1978 was 223 million. Now we're talking 330, 340 million. So, I mean, a big difference there. Again, you're seeing kind of home prices at the levels that we saw in 1978, but population has increased significantly since.
I was thinking that, and great stuff. Looking for the commentary from Lawrence Yun. I always look for that. He gives a great interview, and you can tell he cares very much about this divide between the haves and the have-nots, and how the affordability when it comes to the housing market has made it difficult, particularly as we stand in this higher for longer interest rate climate. When you kind of compare this housing data that we had today to yesterday, what stands out to you?
Just a market that, again, is kind of a reflection of this higher for longer environment, as you mentioned here, and really one that kind of, again, and I agree with you, I like the comments from Lawrence Yun, and he really does spell it out, how especially for those new home buyers, those first-time home buyers, the difficulties and the trials and tribulations that they face, right? But then again, the idea that this longer-term investment is one that pays out over the long haul ultimately. So, I mean, and then there's so many other benefits of owning your own home, right? I mean, you get to kind of fix it up, and you get to build capital ultimately, or everybody talks about kind of rent just throwing money out the window. But again, I think that it really speaks to some of the trends that we've seen, this higher for longer rate environment, and how it's creating this kind of unique situation as a result.
Yeah, we'll certainly be paying attention to what the Fed does as we get through the balance of the year. Thank you so much, Ben Lichtenstein, with the latest on the housing front and PMI, the latest economic data today. Time now for the morning trade. We're going to dive into Micron ahead of earnings next week. Joining us now for Insight, Jeff Pierce, Senior Manager, Derivatives Trading, Charles Schwab. All right, Jeff, stock under some pressure today, but earnings are next week, and the stock is up year to date. What's the street expecting?
Yeah, that's right. Down about 5% or so. Expectations are coming in pretty high for the stock. 50 cents on earnings, revenue about $6.7 billion. That would be up over 77% year over year. If we look at the different segments, DRAM revenue expected around $4.74 billion, NAND about $1.86 billion, other category coming in about $990 million. And we've seen analysts weigh in with some positivity recently. Raymond James raised their price target to 160 from 130. Wolf raised their price target to 200 from 150. And Stifel, who kept a buy but raised the price target to 165, said that these higher prices are going to really help Micron Technology deliver a strong quarter. They said despite some of the supply disruptions, in April from that earthquake in Taiwan, they still expect that they're going to increase their estimates to the upper end of the guidance range off that better pricing. We saw similar notes out of Wedbush as well. The pricing seems to be coming in relatively strong as demand is very high for these memory chips, especially with everything going on with AI.
Okay, so we've had this optimistic commentary from analysts that's been really kind of fueling some of the gains. Not today, per se. We've seen some price targets lifted. What else should we be paying attention to when it comes to the tailwinds for Micron?
Yeah, well, listen, investors know the memory market is cyclical, and it looks like we're in an upswing from the last downturn. Their Q3 performance is expected to be really positively impacted from the strong demand of memory chips used with those graphic processing units that are in those AI servers. Data center operators, that use that generative AI and large language models, that they need memory, which is crucial for that process, and that's what Micron's providing. Also, expectations of the AI that we're going to see in PCs and smartphones are going to really spark more demand. Micron's going to be the beneficiary of that. Now, there are some concerns going into next week's report, the potential impact from that April Taiwan earthquake. Consumers a little soft on spending when it comes to PCs and phones right now. That could certainly hurt the company. But we know that they expect the HBM to be a multi-billion-dollar business by 2025. They expect about 50% of PCs to be AI enabled by 2027. So longer term expectations are fairly high in terms of their DRAM and NAND sell prices.
Does Micron still have a price advantage when it comes to its products?
Yeah, right now it seems like they do, right? They have a relatively tight demand out there, and we're continuing to see that demand expand. Now we could see some restrictions in China, which sort of kind of push that down a little bit. That is definitely a concern. There are preliminary discussions about restricting exports of high bandwidth memory chips to China. That would directly impact Micron. Having said that, looking at their new GDDR7 graphic memory chips, those are expected to come out, which are going to be focused on AI, gaming, high performance. That is all expected to be a positive boost for the company. And if we look at 2023, about 71% of their revenue came from DRAM chips, about 27% from NAND, and we're continuing to see those prices rise. So this is going to be a tailwind for the company if that continues.
And Jeff, earlier this week we had seen a note from Stifel on Micron, and they did mention, yes, it has a lot of tailwinds. One of the headwinds that it talked about was supply disruptions due to an earthquake in Taiwan. What are we seeing? Are there any other headwinds that we should be watching out for, anything with its margins?
Yeah, certainly the earthquake is something that I think we're gonna look at the numbers and also probably hear some commentary on that. That disruption is is a concern. But again, Stifel still increased their estimates even with that. The other thing is, although we know that memory for AI demand is very, very strong, is the consumer still relatively soft when it comes to buying PCs and buying new phones. We know that, we know that the PC cycle is expected to really pick up in the second half of the year, but so far that hasn't happened. Now, they could get in a especially large boost as we see these PCs get AI enabled, along with the mobile devices. So there's some, the headwind could very quickly turn into a tailwind depending on how the consumer reacts to purchasing these new items.
All right, Jeff Pierce, great insight on Micron there. Thank you, Jeff. All right, time now to trade it. We've got Dan Deming, managing partner of KKM Financial. Dan, thank you so much for joining us this morning. All right, let's take a look at Micron. Shares are under pressure today, but it's up majorly year to date. How are you playing this one?
Well, I'm telling you, when you look at the price action here, there is, it's peaking. To me, it appears that it's peaking short term. The 2 days of price action is pretty dramatic to the downside. And we're seeing it kind of play through the semi and, the cloud computing space here the last couple of days as some of the air is coming out of some of these stocks after peaking yesterday early in the session. And I think, when you look at just the general trends, longer term, Micron probably is in a good position, as they continue to evolve through this AI and chip-driven type of scenario that the market's experiencing. But I still think short term, there's still some potential risk to the downside as some of the expectations are starting to slowly work their way out of the market as far as the valuations and some of the other dynamics that the market's contending with as we close out another expiration cycle and go into a period here where typically this week after June expiration is a little bit of a challenge for the markets before we hit July, which is usually a very good month for the markets. And so I'm looking at the opportunity to possibly pick up the stock below the current price level by selling a put spread with my trade example this morning.
And then what risks to the downside? You mentioned risk. What risks to the downside are you watching?
Yeah, so I'm looking at the technical aspects of it, and to me, it looks like it's got some pretty decent support between the 125 and 120 level. So we still got a little ways to get down there. We're trading about 138 right now. We did trade down to 137 intraday. So I'm looking at selling a July put spread for the trade example this morning, and that's selling the July 120 put and then buying the July 100 put. Now, the idea here is really the setup is to get long the stock at this 125 strike is what I'm selling, and then the 100 put I'm buying. The idea is to get long the stock right around 120. And you can sell that put spread when it was at 137 for 5.
Looking for a broker that can match your drive and ambition? Don't settle. Worldwide Jets, worldwide Mets.
On The Breakfast Club.
She's a culture shifter. She was able to get y'all to see something and understand something that nobody could get you to see.
It's time to set it off. All right, so y'all know at Kendrick's Ken and Friends that just happened, his concert, everybody was there, but fans immediately noticed that a couple people weren't there, which was Snoop and The Game. And social media users started making memes and making fun of The Game, always talking about how he'd be left out of West Coast celebrations. And The Game got fed up with that. He ain't like that. We know he's a little sensitive, and he hopped on Instagram to address the situation. He was on live for 17 minutes, and this is what he said.
Now, as far as the motherfucking Kendrick and Drake that's Kendrick and Drake. You know what I'm saying? They Kendrick do his shit, and what he did last night, that shit was amazing for the West Coast. I sat back and I watched it. I ain't have to be there, you know what I'm saying, to think that the shit was motherfucking cool and major. That's cool, man. I think it's a dub for the coast. I think that what K-Dot did for a lot of West Coast last night was hard as fuck. Why y'all wondering why I'm not here and why I'm not there? I'm doing me. That's why motherfucker. And everybody that was there was doing them. I love to see on the, on the coast on one stage and from different hoods doing their shit. That shit don't make me sad, man. It makes me happy. I love to see that shit.
He did sound a little mad though.
I think people don't realize. Yeah, and I think people don't realize this wasn't a West Coast All-Stars concert. This was Ken and friends, and Mustard had some friends, and Head had some friends. They curated who they curated. They invited who they invited. There's a lot of people from the West Coast, you know, who could have been on that stage. E40, Too Short, Ice Cube, they wasn't there either, but, you know, it is what it is.
Yeah, but E40, he did the voice. Yeah, he narrated.
Yeah.
But I think the Game is one of the biggest West Coast artists that don't get a lot of love. But he was in a weird predicament, right? Because he's from the West, but Drake's his homie. So, I mean, it is what it is. But you know, I think Game is one of those artists that don't get the love he should, being a West Coast artist.
Yeah, a lot of people speaking of
Quick
Drake.
question,
It was Go ahead.
Did Game make a choice, or did he just not get invited? Like, did they ask him to come? I didn't see the whole live, so I don't know.
That's
Did
that's
they ask him to
exactly
come
what
and he said no.
That's exactly what he was saying. Well, not what he was saying. People pointed out that he probably wasn't invited because he sided with Drake in the beef during Kendrick. I mean, you know, with Kendrick, like he sided with Drake. And then he also talked about his relationship with Drake as well, because they was asking him that in the live. That's what he said.
As far as my relationship with Drake, Drake is my brother. I fuck with Drake. Drake, if I call Drake and I told him I need this or I need that, he gonna do it. If I tell him my kids want concerts, tickets, in that bitch. You know what I'm saying? I'm a father first. And my loyalty is what motherfuckers is loyal to me.
And then, you know, in the live, he referred to Drake as his brother and he referred to Kendrick as his homie. So it seems like he do have a deeper relationship with Drake. I mean, but it is what it is. And at another point of the live, he also claimed that Top Dog offered him part ownership of TDE, but he said that he declined that offer. So, yeah.
Yeah, I'm sure that was early on.
I don't know
right?
what's going on here.
When it was starting, I'm sure. I don't know.
I don't know what's going on here. But I'm just saying, I'm really trying to figure out, did he get invited and he chose not to go?
Yeah.
What's happening?
Maybe could have been.
Like, what is he explaining? I don't understand what is he explaining, and who is he?
He
explaining
just said that he said that he got mad. Like, y'all worrying about why I'm not here, why I'm not dead. That's because you're always in everybody's business. Like you be everywhere, even when don't nobody be like, hey Game, what do you have to say about this? You say things and you be putting yourself in stuff. But he took the side of Drake during the beef, and then he sat home and watched. He said that he sat home and watched. A lot of people figured because he was from LA that he should have been there. And you know, comments get under the Game skin too. So that's why he hopped on live all mad and said and everything that he said he wasn't, just to prove the point. You know, I don't know where the TDE thing came in, but he just wanted to make it clear, like, he cool with both of them, but he just closer to Drake. It is what it is.
Okay.
So.
And you know, also too, he was talking about it yesterday. Snoop was on tour. I heard Snoop was in Canada. I think they said Snoop and DJ Quick. Actually, they said we're in Canada.
They was in Canada.
Toward that area here, but for right now, you know, we're hanging on.
Yeah, pretty well-defined trajectory here. We're talking 2 steps forward, 1 step back, trend up, bottom left, top right. I mean, we could describe it 5 or 6 different ways. I've been saying all week, blindfold me, spin me around 10 times, Rick, put a dart in my hand, and I'm going to throw it and probably hit something that's fundamentally bullish this market, right? And you can see, again, with that gap, the rollover activity, a bit of a pullback, but still, again, holding these upper levels, right? Still holding about 5,500 convincingly, to your point,